Please, let's start. We are running 7 minutes behind and we don't want to end too late. Please do come in. We are about to start our evening and final session. Welcome to all of you who are present in the room. We are now going to welcome another speaker on a very, very different subject. We have Ms. Dr. Sandesh Kirkire, ex-CEO Kotak Asset Management. He is an investor, academician, and philanthropist. His session is going to be business strategy to survive and grow. After completing his engineering and masters in management, he began his career with 3 years on the shop floor before embarking on a 25-year journey in financial services. His experience spans corporate finance, investment banking, treasury, and funds management, with the last 15 years in asset management, including a decade as CEO of Kotak Mahindra Asset Management, where he scaled the business from $1 billion to $7 billion. Since 2014, he has built a diverse startup portfolio in telecom, big data, e-commerce, wearable healthcare, and education, offering his expertise, network, and capital to support sustainable enterprises. He is also engaged in academics as IMC Chair Professor of JBIMS. For those who don't know what JBIMS, I presume it should be Jabnalal Bajaj Institute of Management Studies. Research, teaching postgraduate courses in finance and in philanthropy through a foundation supporting NGOs in education and livelihoods, further strengthened by his work with Shraddhanand Mahila Ashram for women and child welfare. Please put your hands together for Dr. Sandeep Kirkire, business strategy to survive and grow.
हो गया भेज दैट चालू हो गया इधर है. So good evening all of you. I have been witnessing some of your presentations in the morning. It's a tough business that all of you are leading. This is the first time I'm actually addressing something which is not about investing as much as looking at it from your side of the table. When Tushar came and said that you should address, I was just thinking that how do I, because all these years, all 25, 30 years, it was all about me lending, me investing, and we looking at a company from the other side. So what we are going to do here is understand, I know all of you are business leaders, all of you know how to run business, but how do we create something which is sustainable beyond all of you? That is what real business is all about. Business should outlive, and one, and number two, finally, nobody is here to do charity. So everybody is here to create wealth. So we have to look at it from that perspective also. Some of the things that we learned actually in school level mathematics is what really drives valuation. So I'm going to end this with valuation. How do we look at valuation of the enterprise that you're creating? There's going to be a small worksheet which I share with my students. I'll leave it behind. And you individually, each one of you can create and compute your own business value going forward. So let me go through some basics. Any business, it has a purpose. There is a customer, and basically there's a customer at the the core, and then there is an employer and employee. There's always a tussle between the two, between employer and employee, depending upon demand and supply. And so today, 3 years back, coders were so much in demand. Today, coders are surplus workforce. So it all boils down to business dynamics. And but one can't ignore the focus on customer, because that's the key. You shaft a customer once, and that's the end of your business. And for doing all of this, the main facilitator is the capital. Now, capital can be your own capital or somebody else's capital. Now, all of us know that there is somebody who is willing to lend money to us. He is very much willing to lend money to us, but is that something which we should be opting for? Is the right decision? Because I know so many of my friends who have gone through tough times because of the debt component. So when you are talking about returns, any business, it's all about return on equity. It's all about return on capital employed. So return on equity, return on capital employed, because capital comprises of both owner's capital as well as outsider's capital or the borrowed capital. Now, when you are talking about ROE, ultimately it is after tax. Finally, are you really creating profits after tax? Because tax is something which you cannot ignore. And are you beating market returns? And we'll get back to that in a bit as to what exactly is market returns and how should one look at market. When one looks at the fact that, okay, equity markets good, what should be the return expectations from the market? I'll touch base on that in a bit. And finally, when you're talking about return on capital employed, are you really creating, and most of the businesses actually falter on this, which we have seen over the last 35 years that I have been a student of the market, that you falter on this weighted average cost of capital. In the sense, are you computing, are you beating your returns, is the business throwing cash flow in excess of the weighted average cost of capital? When you talk about weighted average cost of capital, you talk about equity which is after tax and debt which is before tax. The reality is debt is a great advantage, yes, because debt helps the shareholders. You borrow for 3 years, and if the machine works for 7 years, for the next 4 years, the accretion of the cash flow of the machine goes to the shareholders. So in that sense, debt is very important. However, debt can kill you. So when you are talking about, So when you are talking about, where is that? Can you see this? Suddenly it's gone. So when you are talking about debt capital, it will come back. So debt has a direct cost to be paid. Where is it gone? This is the one. So debt has a direct cost. It has to be paid at any cost. However, if your business is not generating sufficient returns, sufficient cash flow to protect that debt, debt can kill you. And I've seen several instances where debt has really destroyed the business. Equity is not something which you are supposed to pay, but equity is the most valuable because it's equity, because it's ownership. So debt can kill you. It enhances the shareholder return, but it can kill you. It's far cheaper than equity. But you have to be very, very careful. There is a lender waiting to lend money to you. He is doing all his analysis. He is using all the bureau data. He is doing all of this. But we should be, equally cautious when one is looking at what kind of a debt. Too much debt can kill you. Too small debt is not great for the shareholders. It's the shareholders' accretion of returns which happens through debt. And as I said, equity is the most expensive form of capital, but one has to perhaps give up equity if there is too much debt. So one has to look at mix of debt and equity for maximizing yield. So business is all about simple. I mean, all of you know, finally income has to be more than expense. Clearly, there is no two ways about it. But it's all about relationships. I'm just reading a book on Apple, how Apple has actually helped China, or in my younger days, Procter & Gamble and Godrej used to fight with each other, and Godrej used to manufacture for Procter & Gamble. So they on the brand, in the marketplace, they are competing, but there's one guy manufacturing. So essentially, it's all about relationship, it's all about outsourcing. We have seen all of this happening now, especially in this entire tariff mania which one is seeing. You're seeing how, the whole world is actually, getting, it's all about branding power. I remember one of the examples that we give to our first year MBA student is businesses with negative working capital. Now, those are the most valuable businesses. Hindustan Lever doesn't have a factory. People buy their products. They don't need capital. They sell on cash and get credit on the other side. In my younger days, when I was doing my MBA, those days it was only Hindustan Lever. Today you look at every large business, like, when I passed out engineering, I remember the people who joined Bajaj Auto or a Tata Motors had to spend time in the inventory departments. And we used to only hear about Kanban system of just-in-time inventory, business inventory of Toyota. Today it's a normal. Today you look at Bajaj Chakan plant, the plant opens and the inventory is outside on the road. So you have transferred your entire inventory cost, everything to the second man, and this is how ultimately the entire business of outsourcing is what is helping large corporates. So ultimately, why are we in the business? We are in the business to create wealth. How do we create wealth? Your business has to generate returns in excess of inflation, no two way, on a post-tax basis. So any wealth creation exercise, just to give you a perspective, money in my pocket is losing every day some amount because of inflation. Money in saving bank account and current account is actually having negative return. It's a wealth erosion. When money is in the fixed deposit, it is perhaps giving me inflation return. But the reality is that is not wealth creation. When you are talking about market returns, when people say, oh, what should be the return expectation from the market? And people will say, oh, 15%, 20%. There's no the logic is the right expectation from the market should be the nominal GDP of any economy. If you look at India, over the last 30 years, average return of Nifty will be around 12-13%. That's the nominal GDP of India. So return expectations from equity market is 12-13% anyway, without doing anything, without doing any headache. I am getting now, earlier it used to be post-tax. Now, we are moving at 12.5%. Perhaps we will move to the long-term capital gain tax of 20% over the next 5 years. It's very logical, but that kind of return market is generating in any case. So when one is looking at business, one should be looking at business. We should be looking at the fact that, okay, this is the return expectation. This is the return landscape. The whole landscape starts with what? The repo rate of the government of Reserve Bank of India. That's the overnight rate. From there, the entire yield curve happens, and from there, the entire returns from the markets happen. So when you are in the business, the whole idea for being in the business is to create wealth. And if that being the real objective, valuation is something which one has to be very careful and to understand how the valuation happens. So I want to show you one worksheet which will give you a stark important analysis as to how the entire compounding works. There was a case where somebody said that, somebody is retiring from the market and is very, doesn't want to take any kind of a risk. He just wants to put money in State Bank of India. It's a risk-free product, absolutely risk-free. And I'm going to show you something, and then you'll wonder, is it really risk-free? I need some help on now. Just show me how do I go back to that worksheet. So this guy who is retiring, having a crore of rupees, saying that I don't want to take any kind of risk. I'm just putting all these dots together for us to finally get into discussion on how to value individuals' business. So what happens between investing so, the whole idea was, can I just put money in State Bank of India deposit? And this guy incidentally was retiring from State Bank of India. He said, I don't want to take any risk. From a banker, from financial services, that's what he was saying, that, risk-free product hai, I just don't want to take any risk. Equity markets go up and down, blah, blah, blah. So I'm just going to show you a worksheet, and then you will really wonder, is it really risk-free to be in State Bank of India? SW, this is the one. You can see? Can you blow it? You may not, this is gonna, yeah. So I said, State Bank of India is risk-free. So those days the yield was 6%. He said, I am going to get 6% every year from State Bank of India. And I'm quite certain that SBI will never default. So then I said, how do I, help him understand that the fact that he is bringing in 6% in his pocket, technically the money that is lying in SBI is losing 6% every year because of the inflation, right? So when you are looking at SBI, the other option was to put money in Nifty. Why? Nifty gives me 12% return. Blindly just gives me, not every year, but over a 10 and 20 years, that's what the Nifty gives me. And I can buy Nifty. So 20 years later or 10 years later, this Nifty of this 1 crore which is lying in Nifty is worth 1.92 crores. That 1 crore which is lying in SBI, because I am taking out 6%, but that money is losing, is worth 53 lakh rupees. And after 20 years, that 1 crore which is lying in SBI is worth 30 lakh rupees. So you have, in your mind, the view was that this is the risk-free, but you have actually lost 70% of your earning power just by keeping money in State Bank of India. So when one is looking at value creation, one has to look at inflation, which is a killer, and that return and the creation of business value is on a post-tax basis. One thing we said that debt is killer. We have to be very careful. Not using debt is bad, but using too much debt can kill you. Now the question now is, how do you value your business? I got it. So there is the whole business of valuation is not about what has happened in future. So amount is equal to principal into 1 plus r raised to n. That is the formula we learned in 3rd standard. In 3rd standard, we learned this formula of compounding. The formula of compounding essentially, in school, the teacher gave us principal and return and n, and we computed the amount. In the real world, we are trying to find P. The valuation game is all about looking at the future. The looking at the future means looking at your potential to earn returns in future. What has happened in the past is, if you're valuing a business, I mean, if there's an acquirer for your business, the first thing he would say is, can the business survive without the promoter? Which means institutionalization of the business is the key for valuation, which means that business should perform, exist, grow without the promoter. That is one. I mean, it's easier said than done, I know, for a shorter, smaller business, but that's how any acquirer is going to look at any business. One. Number two, if you want to create business value, the business value can be asset based, which is the value of whatever plant and machinery and whatever that land that you have, or earnings based. A business which is valued on earnings based is far, far more valuable than business which is valued on an asset based. Asset based is that land value or whatever. The issue is how do you actually look at business, create a business which is on earnings based. And that is where this entire concept of discounted cash flow, which is what we teach at school, which is the future value of any business. Future value of any business is a function of your future cash flows. And the future cash flows, each one of you, when you play around with this worksheet, you will be in a position to find out as to what exactly is the business value that we have created based on my future assessment of future earnings. Because that future earnings is what, when I bring that down today, exactly mirror image of what we learned in school, which is in the real world we are trying to find P. Amount is equal to P into 1 plus R raised to N, which was the school level math, is what drives the entire financial system. Only difference is we are trying to find P. We do not even know A, we have a vague assessment of R. So, the whole idea is how do you bring in institutionalization of your business and try to project your business. I know it is very difficult. In a very, very competitive business environment, it is extremely difficult, but that is the only way you can create value based on earnings base. Just to give you brief analysis, it is very difficult to show it here, but there is a, the way it does is you have to project your business. Once you project, so all the stocks which are listed, one looks at P multiple is one way to look at stock which is listed stock. I am saying that the real intrinsic value of any business is driven by earnings model, and earnings model is something which is applicable to any business, whether it is large or small. And that earnings model looks at a few things. What is your weighted average cost of capital? How are you discounting it? That R that we talk about, what the entire earnings model is actually a reverse of compounding what we learnt in school. So, the R is the discounting, which is the weighted average cost of capital. All the businesses that we invest in, or secondary market businesses that one invests in, there is a rigorous exercise which goes to find out what exactly is the intrinsic price. Now, if your intrinsic price is lower, higher than the market price, the investor will acquire the stock. But remember, for every buyer there is a seller. The seller is also doing the exercise, buyer is also doing the exercise. That is the beauty of the market, because both have different sets of assumptions. When individually each one of you is running the business, you would have a sense as to what exactly the future holds in the next 1 year, 2 years, 3 years, and the kind of investments that you need to make to achieve those growth. Now, that is very critical for you to understand that when in this whole journey of running and trying to survive, how do you keep focus on creation of value? Nobody is here, as I said at the beginning, to do anything other than creating value. And for the purpose of creating value, doing the right things on finance, the whole idea is what is there in your control, not the top line. Top line is competition. It is not so much into your control. What is there is your expenses. What all you can do to drop the expenses, and that expense component also includes a very large component which is debt. How do you reduce your cost of debt? Because that is in your control, and businesses fail because they ignore the expense part also. So, we have to look at, while there is going to be there is continuously in the competitive world, there is so much that each one is trying to hold the customer, keep the customer ownership, service the customer. At the same time, you cannot lose your focus on the expenses that you are running. I know that you may not be doing it, but the reality is you have to find out, am I really creating value? And the way you can find out is, am I really beating the weighted average cost of capital in terms of my return? You can compute, there is a formula which you can always find out what exactly is how ROC is calculated. ROE is after tax, but ROC is before tax. So, you can do all of that to compute because it's done at earnings before interest and tax. So to compute whether am I creating value, and value creation is something which is at the heart of your business. So when this came, I realized that can I actually share this worksheet with all of you so that you yourself compute your own value. There is a large component in this one small thing which I want to end with. There is a concept of business is, see, all of this, the assumption is that business is going to be surviving here for infinite period. But you can't make an assumption on your future business for infinite period. So between 3 to 5 years is a period where one makes an assumption on the future, and then you do something called a terminal value calculation. And that terminal value calculation is a large component of your business, of this earnings model, which when you actually go through this worksheet yourself will realize that it will change, it will give you some sense as to, am I really creating value, should be answered by, is my business sellable on the asset side, on the asset value basis, or on earnings value. If it is on asset value, then I am not really creating value. I can be saying that really I am creating value. Just like a lot of retail and grocery shops, they make money only because they do not consider the rental cost, because the property is owned by them. That's not how you should be looking at a business. Business should be looked at on the fact that if at all I am creating value, it cannot be on, and just look at your business. I mean, all the machines which I learned a little bit from Tushar over the last 15 days is that all your assets are depreciable assets, which means that in the whichever, and more so because the technology is changing, which means whenever I take a decision on the asset, I should be so clear that in the next 12 months, 18 months, 2 years, I should be able to fund to pay that debt, because debt is a hanging sword, it can kill you. So how you create the value is individual's expertise, but the reality is when you are reflecting back in your business, am I doing right, should not be only driven by, am I getting surplus money here, am I really getting valued in excess of the asset value. If I am doing that, then I am doing something right. So that's all I thought I can share from that other side of the table, as to when you are buying anybody's business, you are not going to buy, either when you are a buyer, you would love to buy it at the asset base. But when you are a seller, you want it on the earnings base, obviously. So the whole idea is, how do I get there on the earnings base? And that's something which, once you start getting this perspective, you will realize that yes, it's not difficult, but you have to continuously be there to look at every aspect. And I'm not saying you guys are not there, but I'm saying think about value creation. Business should outlive you. Business, even if your next generation is not interested in this, you should not say that, okay, I am selling it at the asset price. It has to be on the earnings base. So when you are creating a business which is valuable, we can say that that is possible only when the value of the business is far in excess of the value of the assets. So that's it. Thank you very much. Any questions if you have, I will be here in the evening, we can meet. Thank you.